Brent Thill of Jefferies elsewhere raising his price target on Facebook to 250, keeping a buy on the stock, writing the following: management guided again to constant currency revenue growth deceleration in the second half of 2019 and first half of 2020. But considering recent improvements to core Facebook and momentum around commerce and stories, we believe investors will question the magnitude of that deceleration. Brent Thill, you don't buy the deceleration story by the sounds of it. Walk me through it.
We don't buy it. So they accelerated their constant currency from 30 to 32 in Q2. The comps are easier in the back half. The product quality is improved. I think the headwinds of the regulatory and privacy issues are over. Users are coming back to the platform. Retailers are telling us that they are just stampeding to put their products on Instagram commerce. So, is just basically an outsider looking at their guidance, which is historically been conservative. I think the pros outweigh the cons, and we don't believe they're going to see the type of deceleration that they're talking through.
Brent, you yourself have said that a clear downside risk is that expenses may have to ramp up. That's not your base case. Why isn't it?
Well, I think many of the expenses in terms of the privacy and additions that they've made to reviewing content are in. They remember last year, Facebook was on defense for the majority of the year. They had to put these investments in. And I think many on Wall Street think they're putting, really expensive people to do content review in Silicon Valley. And they can put these people in other lower cost countries. Secondarily, the AI technology can determine whether the content's appropriate or not that's being posted. And so I think there's other lower cost ways that they can actually comply. And so I think there's a lot of kind of misperceptions in terms of where they're going to have to spend. So yes, costs are going to come up a little bit, but look at the actual acceleration on the top line. And we think this is a very balanced story. I've been saying this even last year when the stock was below 150, that this company's capable of $10 of earnings power. For a company growing close to 30%, I don't think investors are going to pay less than a 20 to 25 multiple. So 200 to 250 is your range. And I think, again, long-term, there's no reason why they can't do $12 in earnings. Again, that gets you to $300 a share. So, we're at the bottom end of this range, and we think that there's going to be, over time, still great innovation coming out of the franchise.
Brent, you've said this materially and repeatedly over the course of the last year on this program. Just on the multiple you mentioned there, do you think we have a floor in the multiple then, regardless of the regulatory issues, a floor in the multiple for this company?
20 times. 20 times is your floor. I just don't think that, again, when you're growing 30+%, why would you pay less than that? I mean, there are other slower moving companies in the market that trade at a higher multiple. And this company has effectively done many of the right things. Yeah, last year was difficult. Did we foresee all those issues last year? No. But again, I think the true north is you got to stick with the multiple range and then continue to let the earnings dictate this. And I think that we found a pretty strong floor. So it's going to probably range between 18 to 25 times. I don't think we'll get back to 30 times. But again, when you start to put the numbers out, you have a pretty strong floor on the stock.
Yeah.
And we think that's in a great position still.